With the stock market, the price of Bitcoin, lakefront cottages all really taking off over the last few months, many people are sitting on a large amount of capital gains. And with capital gains comes taxes. Now, while some have just tried to do this to solve their problem, that's not really a long-term fix. Now, by now, this shouldn't come as much of a surprise. The government certainly knows about these creamy capital gains, and have no doubt they're coming after them. So what can you do to offset these taxes? I'll suggest there's at least 4 ways that you can offset these taxes. And when does it make sense to actually realize those gains versus just deferring them off down the line? Not all of these reasons that I'll list are financial either, so grab a pen and paper and let's dive in. Now first, let's start with a quick refresh on how capital gains tax works up here in Canada. You see, when you buy an asset, an investment, or a property, you've got a cost base. So let's say you bought shares of Tesla and you paid $10,000 for those shares. That's your cost base. Now flash forward to today and you're selling those shares of Tesla, let's just say, for $50,000. Your capital gain is the sale price less your cost base and any outlays or expenses incurred to sell those shares. So in this case, it'd be $50,000 minus $10,000 equals a $40,000 capital gain. Now, up until now, and since about the year 2000, the capital gains inclusion rate has been 50%, meaning you would then take that $40,000 capital gain and 50% of that gain would be tax-free for you. And the other 50% would become what's called a taxable capital gain. So in this case, that'd be $20,000. The final step is adding that extra $20,000 of taxable capital gains onto your income tax return in the year that you sell that thing to figure out how much tax you're going to be required to pay at your marginal rate. Marginal rate just means the amount of tax that you're going to pay on the next dollar of income that you earn. So if you made $100,000 of employment income in a year, the same year that you sold these shares and you added that $20,000 taxable capital gain, you'd be at a marginal tax bracket of about 38%. Here in Canada, you'd pay an extra $7,156 on that $40,000 capital gain. The current federal government's most recent budget proposes increasing that inclusion rate for capital gains exceeding $250,000 in a year up to 66 and 2/3%. This means that for capital gains above that $250,000 threshold, 2/3 of the gain will be taxable instead of just 1/2. So for example, if you realize a $300,000 capital gain in 2025, the first $250,000 will be taxed at the current 50% inclusion rate, while the remaining $50,000 will be taxed at that new 2/3 rate. The inclusion rate has changed, admittedly, in the past. This isn't the first time, and there's obviously debate whether this is going to stick around or not. We'll save that debate for another video. So whether it's 50% or 66%, the reality is this: the tax is still due when you sell something that's gone up in value. So the question is, how do you decide if you should in fact trigger it? Or is it in fact better off just to keep holding on to these assets that have these unrealized gains? And if you do decide to sell, what can you do to minimize that capital gain tax impact? Now, by the way, if we haven't ever met, my name's Steve Willems. I'm a wealth advisor here with Willems Wealth Planning Group in BC. We started this channel to help you plan for your own retirement, helping you think about how to plan and arrange your investments, your income streams, and ideally pay less tax along the way. Now, deciding when to trigger capital gains and pay the associated tax can be a complex decision, and it's going to require careful consideration from a number of different factors. You're going to want independent help making this calculation, but let me give you a framework that you can use to help start unpacking some of the key elements that might influence your choice. Now, one common scenario where capital gains come into play is when you're considering switching from a higher cost investment strategy to a lower cost investment strategy. So let's just say you've got an underperforming mutual fund holding that's got a management cost on the higher end of a potential range here in Canada, and you're looking at something else that has a similar asset mix, but a bit better performance and a lower cost. Now, clearly the fee savings is going to benefit you over time, but you need to weigh that against the immediate tax liability that comes from triggering the capital gain on the sale of your existing fund holding. So for example, let's say you've got $800,000 invested in a mutual fund with a 1.5% annual fee. And by switching to a lower cost strategy, say that's just going to be charging 30 basis points, you could save $9,600 per year in fees. However, if you've accumulated over, let's say, $200,000 in capital gains in that more expensive mutual fund, you could still face a tax bill on this move of about $41,000, depending on your marginal tax rate. So there's going to be a break even here where it might make sense triggering that gain, as you'll be even, all else equal, in maybe say 4 years. In a sense, there's an opportunity cost here of holding on to those underperforming investments solely to defer the capital gains tax. Now, another crucial factor is how your tax situation might change in the future. So if you're nearing retirement and you expect your income to drop significantly, it may make sense to delay triggering your capital gains while you're still at a higher tax bracket. Depending on the size, you might not want to trigger them and inadvertently give up OAS by accident, so you need to keep an eye on that. Now, if you're already retired and maybe drawing old age security, you might actually not want to trigger them and inadvertently give up your old age security by accident, so you might need to keep an eye on that as well. Now, conversely, if you anticipate your income increasing in the coming years, realizing it sooner and paying the tax now might be to your benefit. In some cases, if you now know that you've got a large capital gain coming down the pipe, it might make sense to actually preserve some of your RSP contribution room for the year that you sell that thing to also help manage the impact. But that's for the next section. I'm getting ahead of myself. As you approach and enter retirement, it's common to shift your asset allocation towards a more conservative mix. Maybe you're going to be increasing your fixed income weighting in your portfolio. This rebalancing process may necessitate selling some stuff that's gone up in value and, in fact, triggering some gains. So in this case, rebalancing the portfolio is going to ensure that your overall portfolio isn't more risky than you'd otherwise want it to be, especially as you head into retirement. So rebalancing and maintaining that targeted mix of assets, when done properly, looks a lot more like pruning around the edges rather than a full-blown hack job. So in this scenario, it'd probably be prudent to realize those gains. Now, if you're nearing the end of your life expectancy, triggering capital gains in advance can also be advantageous. On your final day, any unrealized gains on any of your property or your investments, they're going to be deemed sold on the day that you pass away. Now, it's not uncommon to see balance sheets of folks at that point where they've got really, really significant 7-figure gains on some of their holdings. All of these gains are realized on their terminal return, and they'll be much more likely to be all the way through that top marginal tax rate of 53.5% here in BC, but they'll also be through any inclusion rate threshold, like that $250,000 amount that's been suggested. So triggering portions of those gains in advance, perhaps staged over a few years, that can make sense to smooth out your tax rate as well. So those would be a few situations where you may or may not want to realize gains sooner rather than later. So let's say you decide to trigger them. What then can you do to pay less tax? I can think of at least 4 ways that you can kind of plan around this. Now, the first thing that you can do is you can tax loss harvest. Now, this involves selling other investments that have lost value to realize capital losses, which can then be used to offset any realized capital gains in the same year. Now, any excess losses can be carried forward to future years, and that's going to provide you some tax relief down the road. So you're essentially pairing losses against gains, and you're doing it in the same tax year. So maybe you have a holding that you wouldn't mind getting rid of. It's underwater. You sell it at the same time when you trigger the gain elsewhere. You'll need to be mindful of the superficial loss rule here, which prohibits claiming the loss if you repurchase the same or substantially identical security within 30 days after that sale. So keep an eye on that. But for charitably inclined folks, donating appreciated securities directly to a registered charity can be a win-win strategy. So in this case, you're not selling the holding and giving away cash proceeds, though that would certainly produce some helpful tax credits. You're actually giving away the investment or the security itself. You're giving away those Tesla shares or units of that ETF or that mutual fund that you own. Now, by giving the assets in kind rather than selling and donating the proceeds, there are special CRA elections that you can make to essentially allow you access to a 0% inclusion rate on the capital gains of that investment. So you avoid paying capital gains tax on that entire appreciation of that thing that you're giving away. Now, the charity is going to receive the full market value of that asset, and you can claim a tax credit for the full donated amount, and the capital gain that otherwise would have been due is essentially forgiven. It's a double tax benefit. So with numbers again, let's use that $50,000 example. You paid $10,000 for those shares of Tesla, and now it's worth $50,000, and you've got a $40,000 capital gain. Let's say you're at a 45% marginal tax rate. This single move would save you about $9,000 of taxes that would have otherwise been payable. Plus, you get a tax credit that could save you an extra $22,500 of taxes on other income. This is a super helpful strategy, and we facilitate a ton of these kinds of gifts. Third choice is to consider staggering these sales over multiple years. I already mentioned this one already. This might not be possible with real estate assets where you can't just parcel off a single bedroom and sell a single room in a house, but for other financial assets, this certainly might be an option. This is going to help keep you within a lower marginal tax bracket every single year rather than pushing you into higher brackets by realizing all of the gains in a single year. So you'll want to work closely with your tax professional or your planner to kind of optimize the timing and the amounts based on your specific tax circumstances and your income levels to make sure that you're not giving up any other benefits that you might qualify for by staging this out over a couple of years. And the fourth and final option is if you scrapped this whole idea altogether, and instead of selling these assets that have gone up in value and triggering those gains or donating those shares, you instead chose to borrow against those assets using some type of a securities-based line of credit. A lender will extend, say, 50% of the market value of the security as a loan, with the investment serving as collateral. Now, this is going to allow you access to liquidity without realizing those taxable gains immediately. Now, obviously, this strategy comes with interest costs and a pile of other potential risks if the value of that asset declines significantly while the loan is still outstanding. So you need to have a really great financial plan, and you need to not take on too much debt for this to actually make sense. That's a bit of a framework about how you can think about if or when you want to trigger those capital gains. And then if you decide that you need to, how you might be able to arrange things to dampen that impact. This is going to be a really important piece in many retirement plans in the years to come, especially as that inclusion rate steps up and it stays at that higher rate. So it's important to have pretty good help when you're making these decisions. Anyway, that's all for now. I hope that helps. Thanks for watching. I'll see you in the next video.